up ahead. Affirmative 612.
Thanks for hanging out for another edition of the Wealthy Pilots Podcast with Scott Osborn and myself to talk. Scott, we're going to talk a little bit about kind of a follow-up from our chat about a month ago when we were talking about bring the data, right? September and October historically have these, connotations to them. There are some data to kind of support some of that. And we are into October now, so it seemed kind of fitting to follow this back up, a couple of weeks later. But we're kind of tying that in with who do you listen to and how do you listen to things? With the, there's a lot of talking heads, obviously, in every industry, in every world. But you and I were chatting about some of the gurus, big names that through the years have just, cried. I don't know, the boy that cried wolf, maybe, into the world kind of thing.
I guess if you live out in the wilderness and you just cry wolf long enough, eventually there's going to be a wolf around and you'll look like you're right. But yeah. I mean, I think, last time we talked a good amount about what to listen to, which is the data, right? We were, and what kind of triggered that was some comments around, hey, September and October are normally not good months to invest. And, if you looked at the data, we found out hey, they're actually, statistically pretty much the same as any other month. You do have a couple statistical outliers that skew the data, but, it's not like any significant theory to change your portfolio against, basically, is the premise of what we discussed. And so I thought we could talk a little bit about today, okay, if we're going to listen to the data, what should we make sure we're not listening to as well?
Yeah, what are we not listening to? That's a great way of putting it. And you and I were chatting. I was telling you a story about a big financial person, and we won't drag people up and down, even though that seems to be the thing on the internet. But that's not about what we're doing. But this person, pretty big talking head, and for years was like, it's all coming down. It's all collapsing. And this was through the late 80s or early 90s, right? Kept saying it.
Yeah, put the comments out in 89.
Yeah, 89. Okay. And when it finally happened in 2001, right, it was like, see, I told you so. And it's like, yeah. So then how many people did you cost to possibly miss out on that great run that the 90s had?
Absolutely. And that's, to me, the aspect where so many people, I think, at times can feel that they're on the right side of history when they're sitting in cash, and then a market dip comes and they're able to potentially buy the dip, even if they do, let's say.
Yeah.
But what they forget, and what they don't do themselves a good service to, is they don't look back and run the numbers and say, well, what if I was just investing the whole time? What returns did I miss out on by, listening to the fear mongering, clickbaiting, talking heads out there? Mm-hmm. Versus just having a plan and following the plan with some patience and discipline, and knowing that markets go up and sometimes up by a lot. And then also markets go down and sometimes they go down by a lot. Yeah. And typically when they go down faster than they go up.
Absolutely.
And so, to me, I think
it's like weight loss, right? It's the opposite. You put it on a whole lot easier than you take it off, right?
That's a fact.
Yeah,
that's a fact. So, to me, I think of a couple. What really triggered this for me was looking up an old quote from Robert Kiyosaki, the Rich Dad Poor Dad author.
Yeah. Yep.
And he was out on April 4th, which I think was right around or on Liberation Day.
Tariffs. Okay. Yeah.
Tariffs getting pushed out, and market had taken a big dump, and he said, "I should not say this because it's not cool to say I told you so. Yet, I did tell you so." In my book, Rich Dad's Prophecy, I warned the biggest stock market crash in history was going to wipe out the financial security of millions of investors, especially my generation, the baby boomers. The stock market crash arrived today. We are definitely in a recession and more than likely a depression.
Well, that didn't age well. Maybe we should have called this episode "That Didn't Age Well."
I think we should call it that. This didn't age well. So now, since he put that tweet out, the S&P 500's up 32% since he said, "I told you so," back on April 4th, claiming the biggest stock market crash in history has arrived and we're more than likely in a depression. So it's up, 15, 16% for the year, but up 32% from that comment, which just goes to show not that many people really truly know what the market's going to do. And to take advice from people who make a living selling books and making TV appearance I mean, to me is you have to look at where their interests lie. Their
Well,
interests
you
lie
would think,
on
Scott,
maintaining their platform.
yeah, you would think that we would have learned this because we've been inundated in this now for a decade or more, right?
Oh, yeah.
Where sensationalistic anything, and of course now with the advent of YouTube and everybody in there under the sun has a video, right? Or TikTok and Instagram and so on and so forth. Everybody is a talking head. Now there's different levels of these talking head, reach. Somebody who's really out there, but can reach millions of people. But yeah, that's a great point because it's like you can't be right all the time, and you're not going to be right. And if you're selling, sensationalism,
yeah,
then you're going to say whatever.
Well, and I think to me, it comes down to trying to get clicks, trying to get views and get eyeballs
or book sales,
your product, your book, etc.
Yeah.
And to me, that's why I like to push back against the machine sometimes and say, hey, this is not good for investors to be pushing that kind of narrative. And
at least universally, right? At least universally.
Absolutely. And to me, it makes me think too. So I was running some ads on Facebook. Most people have seen them here or there. And a guy comments on one of the ads. He said, hey, how does this differ from a fundamental wealth book like Wealth Without Risk? So I'm like, I'm not super familiar with that book. Let me take a look. I do a little research and find out the author was sued for $14 million because he made all of his money selling books, not through the advice that he was telling people to follow in the book. So he's not living it out. And to me, that kind of hypocrisy is it's rampant in our society today. And, and again, like you said earlier, everybody has a platform. It is upon me and I'm aware that I'm a talking head right now. I can see it.
Right.
But I'm not out there like telling people, hey, I have some crystal ball and you guys should pay to get access to my crystal ball. That's, going to be wrong.
And if you're looking for that,
eventually it's right. Yeah.
Yeah. If you're looking for that, there's 1,000 people you can find that are currently doing that right now. Right.
Well, and I think it feeds into the psychology of the investor, right? As human beings, we are not, it's not super in our nature to be good investors because when things are going down in value, a good investor is going to buy. But the investor psychology says I should sell. Hey, if it's going down in value, it's decreasing in value. I need to get out now and get out now.
Well, you're talking life savings that you've worked so hard for, and most of us don't have the wherewithal to take that gamble, and I totally get that.
Yeah. Well, and so again, I think, just tying it back to that psychological piece. I mean, there's just some critical behaviors that are vital for us to be successful for the long term, right? I mean, one is getting exposure to the right asset classes. 2, time in the market, not timing in the market. And that kind of feeds into these foundational ones around patience and discipline.
Yeah.
I mean, I wish it was a lot more exciting and sexier than that, but patience and discipline get rewarded time and time and time again.
Yeah.
But not that many people have that. They don't have that ability to just say, hey, I'm just going to put money in month over month over month. It's going to go up sometimes. It's going to go down sometimes. And I'm not really going to react. I'm just going to keep taking advantage of what the market's going to give me. And then when it comes time to get closer to retirement or skim some profits to go, put a down payment on a house or whatever the case is, there are times where we're going to look at what's going on in the market and proactively act. Right. I mean, we're coming off of, we're on track to have our third back-to-back year of 20+% returns. So first of all, if you're not getting that, you probably need to look at your plan. Okay. Yeah, second of all, that might be a good time to look at your portfolio and say, hey, do we want to skim some profits and do something with it? If it's in your 401k and you need it for retirement, I mean, maybe we buy, some more conservative asset classes for a little bit.
Yeah.
But I mean, there's times where you can proactively act on what the market has going on, but we don't want to be reacting. Okay.
Absolutely. Yeah. I mean, we're at the time we're talking, Scott, a 1-year calendar overlook, the S&P from last October to this, to now is up 15.66% year to date, just the calendar year of 25.
Right.
It's up about 13.5 to your point. I just saw one of the, one of the big companies. I don't remember, it was, who it was. Was it Barron's or I don't know. Somebody wound up saying they think that we're going to see 7,000 before the year ends on the S&P. Maybe not.
Yeah, we don't know. I mean, markets are unpredictable, right? I mean, they react to news. I mean, that the Kiyosaki's point is about reacting to the tariffs, right? That's what the market was doing. So the market reacts to news. News is unpredictable. Markets respond to news. So we can't predict what's going to go on in the market.
Well, that's the point of you talked about earlier about some of the traditional things, right? Swing it. We could go with the baseball analogy of the home run hitters. You're talking about sexy earlier. Home run hitters, hey, puts butts in the seats. It's sexy, right? But they usually are also the strikeout kings too, right? So, you got to have that. You got to have some tried and true stuff in there. And you got to have a well thought out strategy and portfolio. And if you want to take a few swings, hey man, go for it, right? But just be careful.
Well, and that's again where I like to go back and say, what noise are we tuning out, and then what wisdom and discernment and advice are we letting come in? And I like to just trust the data, And the data would say a lot of times when we go year over year of above average returns, we're overdue for a correction. So I mean, we just sent a note out to our clients recently. Hey, I would expect sometime in the next 1 to 2 quarters, we'd see some sort of correction. Why? Because the data tells us it's overdue to happen. And when it's overdue to happen, it typically happens soon.
But what's a correction? What's a correction? Right.
Great question, right? A correction is when the S&P 500 goes down 10% or more. And then we actually enter a bear market when the S&P 500 goes down, or any market index goes down 20% or more. And so
10% happens a lot through a calendar year. Like, if you're watching it every day, you'll know what we're talking about. But I mean, over time, 10%, we've had a lot of, we basically, some will argue, Scott, we've been on a 15-year, 16-year, whatever it is, uptick since basically the housing bubble, right back in 08, so 07, 08. But there's been some things along the way as well, but it has recovered fairly nicely.
Yes. Yeah. And that's the big difference, right? The big thing is we've had, a good amount of bear markets in that time, right? We had close to one in 2018, COVID one in 2020, Ukraine and Russia war leading to the inflation and mini recession, but market down.
The inflation of 22 was down. Yep, 22 was down.
Tariff in 2025. So I mean, we've had our fair share every 2 to 3 years here, no doubt. To your point, the market's recovered.
Yeah.
Mainly because a lot of the economic data is really good. If you look at like a bear market that typically comes along with a recession, you tend to push down more into that 40% range with the market.
Yeah.
And so we haven't really had that. So I agree, like economically, we haven't really had a significant recession.
Prolonged.
Exactly. And so that's why I think the markets continue to make, pretty rapid recoveries, because the economic data is pretty good. But the market at times is going to get overpriced. It's going to come falling right back down. Then it's going to get overpriced, but it's on that longward trend upwards to the right. We know that.
And we're seeing a lot of that with tech, obviously, because tech drives a huge chunk of everything right now. So.
Absolutely. And so, to me, that's where I think, again, piggybacking off of last month's episode too, we do want to trust the data. But, in terms of if I want to take some advice and listen to somebody, you want to be able to listening to advice that is rooted in data, right? Now we can make some inferences and we can make some opinions, educated opinions, and deploy some plans or strategies based off of that data, but it should be rooted in data. It shouldn't be, rooted in me trying to get more eyeballs on my podcast and trying to drive more book sales or whatever the case is. And then that's where a lot of those folks with that platform are pushing narratives that are bad for people to push their products at the end. Well,
let me point out a point about that. There's a lot of financial advisors who have podcasts. I host a bunch of them, right? There's a difference between people like yourself who are in the trenches, if you will, seeing clients, being governed, right? You have rules and regulations you have to follow versus, even the big guy, even Ramsey, right? He doesn't see clients, right? He has a different empire. It's a totally different thing. Does he have good advice? Absolutely. Does he have crap advice? Absolutely. And it's not for everybody, right? They're not seeing people and working out their specific data. You're talking about trust the data. There's the big data of out there in the world and all that things, but then it's how it relates to your situation when you're running your numbers and stress testing your specific lifestyle and plan. that fair?
Well, and that's where I would think, to me, if we wanted to wrap this up with some action items, like, okay, we want to trust and make inferences from data. We want to build our plans based on evidence, and we want to ignore the noise. Okay. So we talked a little bit today about ignoring some of the noise. So to me, I mean, literally like help train your algorithm on Instagram or Facebook, help train what gets fed to you on Spotify, subscribe to people that are like rooted in data. I mean, change the channel when some of that crap comes on. I mean, like in some of my newsletters I put out, I mean, it's like financial pornography, man. If it comes on, turn it off. It's
Every industry's got it. Every industry's got it.
Absolutely. And so, that's one. The other thing I would say, like more tangibly, if you're getting closer to retirement, if you're one of our folks that are 55 or over, this is a good time to be looking at your asset allocation and making sure that you're not too aggressive. Now, that said, I would say most people in their last decade of work, I tend to see are either too aggressive, they're still investing like they're 35 or 40, or they're too conservative because they're concerned about retirement coming and they got too much over in cash or fixed income or whatever the case is.
Yeah.
And so if we can take a step back and look at the plan and make sure that we feel really good about what does the data say, and then how can we, drive those inferences into our plan and make sure that we're building good retirement income plans and then good portfolios off of that, we can drive to better outcomes, in my opinion.
Yeah. Well, with that said, we're going to have Molly come on and tell you how to get the toolkit. It's not being sold. It's complimentary. So therefore it's not buy my program. It's just, here's some tools to maybe help you out. So go check this out.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own Financial Flight Control Toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
All right, folks. So we're wrapping up. Scott, thanks for hanging out and chatting with us a little bit. We'll see what kind of reactions we get to this. But I mean, it's the world we live in, right? I mean, in every industry, it's out there now, especially with the internet stuff. I mean, look, I'm a musician. I got guitars all over me. It's in the guitar world too. Like, it's everywhere. So just again, filter the noise a little bit. Train the thing. I love that. Train your algorithms.
Yes.
Yeah. Appreciate your time, my friend.
All right. Be good.
We'll see you next time. Don't forget to subscribe to us on Apple, Spotify, YouTube, all that good stuff. You can click on the links below to get some time on Scott's calendar. And of course, just hit the thumbs up and the notification bell to catch new episodes when they come out. And we'll see you next time here on the Wealthy Pilots Podcast with Scott Osborn.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.